Hello and welcome to Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. Please note at the bottom of the screen you can probably, with one click, give us your opinion in terms of the market direction over the next 1 to 3 weeks, and that will help us gauge market sentiment from a very unique perspective, that being traders that are part of the Market Gauge community. And if you're not already receiving this Market Outlook via email, please also register on the website at marketgauge.com so you can be the first to know each week when the Market Outlook comes out. So, as I said, I'm filling in for Keith this week, and when I do, I like to see if I can find just kind of an interesting anecdote in terms of where the markets are, and it's not always possible, but this week I think I've got one, and actually it's quite interesting in my opinion, and that is, everybody knows that timing is everything, and timing has different meanings to different people, I suppose, when it comes to the markets. But let's take a quick look here at the Q's weekly chart, and what got me going in terms of this thought process was I noticed, as I'm sure many of you did, the almost head and shoulders type formation on the Q's, and it's been bothering me for a while, not necessarily the head and shoulders portion of it because we're a long way from the neckline, but I am a big follower of the pattern that the swing high before the ultimate swing high is very often a major stopping point for the markets. And so I've been focused on the Qs from that perspective for quite some time, a number of weeks. So what became, I would say, pretty obvious this week is that the time that we've now spent rallying from this low seemed remarkably close to the time here, and that got me thinking that I would just take a quick look at some cycles. I'm not a big cycle person. I believe in them. I know they're out there, but I don't study them at great length. If it's really obvious, then I'm going to pay attention to it, and I think what we've got here is something that is really obvious, worth paying attention to, and here it is. So I set up this cycle based on the time frame between the highs of these two swings. And when I do that, you'll see that we've got the next line here, and so each pink line here, magenta line here, represents the same amount of time. So this week coming up is the next pink line, which would suggest that if the market is going to top out in a very rhythmic way, we are in the process of topping out, at least on a minor level. When I say minor, I mean I'm not suggesting this will be the top for the year, but it's definitely warranting. Time and price are really coming together here next week. Now, if the thing that makes it interesting is that this cycle time frame is based again on the last two highs, but if we go back in time, we can see that this cycle has had a significant impact on the markets going back as well. The prior high was just a week off from the same cycle. A high in here was ideal, right on top of it. So the market is in this rhythm in the Qs on this time frame. So something not to be ignored. And let's just take a quick look at how it lines up with the SPY. All right, and the SPYs are very similar, as you'd expect. Line up almost exactly on the SPYs. Now, in this case, if we look at the closing basis, it's exact. If we looked on the absolute high basis, the time frame should have been right there. But again, if we go back and look at a last major high, lines up with it as well. All right. So again, this week coming up, that's the next pink line, for lack of a better term, or I should say the next cycle high. And I think it's well worth knowing that from a cycle point of view, even if we're not looking at a top that is going to sell off in a major way, pressure on the market from this cyclical perspective certainly should not come as any surprise. I always like to look at price action, so this is more concerning to me if we start to see more negative price action. If we continue higher, then I can't argue with it, and I'll follow it to the upside. So should we consider, what can we look at to consider whether we're looking at a market that wants to go higher or not? So let's stick with the weekly charts for a second. Take a look at the major indexes, SPYs. If you recall from my video, not last week, but the week before, we're up near some pretty significant resistance lines, like the one that we see here in the yellow. What I want you to pay attention to as I go through the Market Watch 4 is the 2-period RSI here. In every case except for the Qs, we have the pattern of having been oversold, and now last week gave us the first down day in the RSI. So what does that mean? We got some negative price action from an oversold condition, and that is where I start paying attention to the likelihood of the market having hit its peak. And while I won't go through all the peaks here on the chart, if you pull up a 2-period RSI on a weekly basis, you'll see it's pretty good in terms of identifying tops. And top, again, meaning a sell-off that you would not want to get caught in, not promising that it's going to be a major collapse. I wouldn't say I could predict that at this point. And quite frankly, I prefer to look at the markets in a way that the first initial sell-off is not the big one, it's the second one. So we haven't seen the first one yet, but I guess what I'm suggesting here is that the time could be getting close. Top of the channel, RSIs have gotten overbought and now ticked down this week. So there's the SPY. Let's take a look at the diamonds. All right, they ticked down actually last week, or last week brought the tick down. This week we're still up near the top of a channel, so a really perfect place for them to be topping out right against the old highs. And while I didn't check the cyclical nature of this, it's looking like it would probably line up very nicely as well. So nice consolidation. If it breaks higher, it's extended. There's no getting out of the fact that the market is extended on a price basis, but markets can stay extended for some period of time. The concern for the bulls is when it starts to break down, and we're definitely in a place where you have to be concerned. Let's take a look at IWM. Again, RSI last week brought the tick down, so further weakness at the top of this parallel channel here and getting close to the bigger white-based parallel channel as well. All right, extended, overbought, negative price action is something that you should be concerned about. And finally, the Qs, which we were just looking at on a cyclical basis. You can see how I've got the lines drawn here. Didn't quite get to overbought to the extent as the others, and it just hasn't gotten there. And actually, I think at this point, that's a negative. Qs just have not been able to get going. I realize in part has a lot to do with Apple, because if we look at Compex, which is the whole composite, we've got a much different picture from the NASDAQ point of view. But when you get different, you've also got the same, which is the RSI has topped out. It has topped out. And another, just a small point of mention or comparison, notice that here's the initial high. You make a new high, but just barely, and now we make another new high, but by even less. That's just not as convincing as the other broad index, IWM, which at least has made a significant new high over these prior levels. So if I had to guess, or had to have my way, I would say a nice correction back down to this level in the broad market would be healthy, maybe a little further in to really shake more people out. And that's a significant correction, one that's worth getting out of the way of, in my opinion. Provides an opportunity for the bulls, but doesn't necessarily satisfy the ultra bears. So just looking at the price action and the RSI, little good reason to be watching out for some weakness. Now finally, let's take a look at the TLTs, all right, interest rates. An interesting thing is going on here. I didn't go back and look at it mathematically, but the last 3 weeks have been inside the week prior. And between that and the sheer constricted nature of this range, I don't see any time in the last several years that the markets have been this boxed in on that small of a range. And that really can only mean one thing, and that's a significant move moving forward. When the markets get that wound tight, they move. So which way? Well, I've got the lines drawn here to try and illustrate a pattern. The market here, long bond, seems to have rolled over, which would indicate higher rates. And I'm saying that because you've got the quicker moving averages rolling over, but I'm also saying it because you can see that the market sold off, tried to rally back up, and now broke down, consolidated for a little bit, and is now broken down, making it a pretty major, fresh, new swing low. So even if it rallies back up here, the whole picture is looking like it's beginning to roll over. And we've been saying this for a while, so I'm sure this doesn't come as any surprise. If it doesn't roll over, if it doesn't rally, this consolidation here makes for a really easy expectation that a break below that level could take us down to the next level, which we happen to have two things lining up rather nicely, which is the parallel and significant swing levels. And I should have carried this over to this high here. So this 110 level, I think, is the level that really we should be looking at as a likely place that TLTs are going to head. Now, I think that this brings up the question, or an important point, of is this good or bad for stocks? If the TLTs are moving down and rates are going up because we've got strong economic news, and the belief is that it's the economy pushing rates up, I think that's not a bad thing for stocks, and stocks could rally on that. However, if the TLTs and the longer bond rates are moving in this direction because the markets are beginning to feel that the Fed is going to let off on the gas of the liquidity it's pumping into the system, then that could indicate that the markets are worried that without the help of the Fed, we are in trouble, and the interest rates are not going to stay low because the Fed is the reason for keeping the rates low. So in other words, if the economy is not necessarily ready to accept this, but it's happening because people fear that the Fed is going to let up, then I think we could find ourselves in an interesting position where we've got rates going up even though they really shouldn't be with the economy's condition, and it's all because of the Fed, or I should say the perception of the Fed, and you will get stocks with a major headwind and a reason to sell off. In the last several instances of Fed easing slowing down, stocks have suffered, and as I just pointed out, stocks are in no technical condition right now to take a hit in terms of a fear of a lack of liquidity by the Fed. It would be bad news for stocks. So if the TLTs move lower, you want to know why they're moving lower, and that's going to give you the indication of what to expect from the stock's point of view. You may recall, again, 2 weeks ago, I pointed out what I thought was an interesting situation in the charts, which was that the euro, and I'm not going to go through the whole analysis. If you want to see the analysis, go to not last week's, but the prior week's market outlook. The conclusion of the analysis was that the negative price action of the euro, dollar getting stronger, euro getting weaker, right at the black line, which is a 200-day, could indicate a weaker euro ahead. And if that happens, that has, over the last several years, been negative for stocks. So I just bring this back to your attention because we had a negative price pattern on a weekly basis, and it has continued to follow through on that pattern, which is negative for stocks. Right, in the last 2 weeks, we have seen the stocks flat to negative along with this trend. So I would keep an eye on the big picture, what's going on with the dollar and the euro, because it is very likely to be indicative of what stocks are going to find. So let's look at the internals. I feel like I'm talking a lot about the bearish setup for stocks, and it's true. I think there's a pretty good argument for it's time to see a correction in stocks. But let's look to see what perhaps the internals have to say about it. Okay, let's start. Well, let's start with the VIX, and then I'm just going to go through the indicators that we typically look at for you on these weekly videos. I'm not going to read a lot into the VIX. The VIX is so compressed that I find it hard to get too confident on it one way or the other. And when I say compressed, I mean look at the bands around VIX. The sheer level of it is depressed. So normally we would be saying take out the upside of the band, and you've got a nice spike in fear, and that should indicate a short-term bottom possibility. As it turns out, that is what we saw on Friday. So it is doing its job here. My only caveat would be that it's so compressed that it's hard to call a pop in the VIX up to 15 in a compressed environment being a very convincing, even short-term bottom. So yes, that would represent a bounce. We've seen the bounce. I just wouldn't get too excited about too big of a fear reading at this point at these levels. That said, it's the highest bounce we've seen all year. It's the highest VIX we've seen all year. So that's nice to see from the standpoint of got a correction. We did see some nervousness. Next thing we should see is a small bounce or a bounce. We saw that on Friday. Could continue into the week. Remember, the picture that I was looking at up until this point has been weekly. It takes time for these weeklies to develop. So a bounce here shouldn't be confused with the weekly timing over bought potential headwinds for stock scenario that I just pointed out. So one scenario with that would be we could be range bound for a while, with the lower end of the range kind of getting a little bit lower than the 1500 level that we saw Thursday, and the upper end of the range probably not much higher than the previous highs that we've hit. So there's one scenario that would play out that would be in sync with what I'm suggesting, somewhat of a bearish tone, but not ready to really sell off too significantly. And somewhat supporting that potential is the McClellan. McClellan internals here in terms of advanced declines uh, sold off to the lowest level that we've seen all year, and a level that has often been short-term support in a strong bull market. This is a level that you would expect to see support. So sold off to that level. I mean, we look at these indicators to tell us what the market, the condition of the market is. We don't want to simply override them because we have some other reason to believe they're not true. I'm not going to do that. At this point, it looks like it's a good area for a short-term bounce. One caveat, again, price action is everything. If we break the 1500 level, technically, don't look for a McClellan to save a market that's breaking down. Look for the McClellan to confirm a market that's apparently bouncing, that it's bouncing from an oversold area and it's got the conditions to have a significant bounce. We have, I would say, the conditions to certainly bounce back up to the highs short term. If we look at our 10-day advanced decline sum, I'm going to call this neutral. It certainly hasn't sold off enough, which would be down near this red line here, which I believe should be a minus 2,000. Has not sold off to a level that would let this indicator be telling us we've sold off enough to bounce. So I'm going to give that a neutral and not spend a whole lot of time on it. And the shorter term indicators on advanced decline and up-down volume, where we've got the advanced decline oscillator up here, I'm going to give this essentially a neutral rating as well. Not oversold enough, coming off overbought, but kind of right in the middle, and volume confirming that neutral assessment. It just really hasn't gotten to a level where it's worth paying attention to. And that's how I would look at these indicators. If they're not at a specific level that represents one extreme or the other, I don't want to over-analyze them. Now, this isn't one of our standard indicators, but it's one I like to look at it from a bigger picture point of view, and it is the relationship between defensive sector of the XLP and the XLYs. So the idea behind this is if you've got this spread moving up, you have the market moving into more defensive names. So I look at it on two levels. Where are we relative to the spread's 20 period moving average, and what's the trend? So now we have gone from a scenario recently where it's been pretty firmly trending down below the 20 period moving average, which would suggest a market that is not looking to run into defensive names. But that shifted in the beginning of February and accelerated this week. So this is a longer term view. You want to look at the longer term trends. And so the way I would look at this is that the market has become more cautious up here and looking to be more defensive. If the market continues to sell off and this continues to stay above the 20 and trend higher, it's an indication to me that the weakness could continue to get weak. All right, if we sell off and this pulls back into here, it would indicate that on the sell-off, investors are actually getting more aggressive in terms of buying the dip as an opportunity with the expectation that the market is going to rally higher, and I'd watch out for a rally. But for right now, the analysis is quite simple. We don't want to see this relationship continue to move higher and the market get weaker. It would indicate that the market is getting weaker and wants to continue to get weaker. All right, so with that, I think I've gone through everything and would leave you with one last thought, which is we had a significant hit in the market. We had a lot of negative patterns, key reversal patterns. We're rallying back into. We're going to rally back up into them, or at least we did on Friday. If we continue to rally back up into them, the areas that, and let's just take a look at. Let's just take a look at the SPYs on a daily. The area we want to watch out for from the bullish or side of view, which meaning concern for the bullish point of view, is the area, the highs that we were at before the last attempt to move higher. All right, that's the first, or I should say most significant price action level that we want to get above to feel that the bulls are kind of back in control. And more significantly would be to watch out for that level if we roll over there. That would be a very big indication to me that the break we saw last week was a real break that the market's not going to recover from as quickly as it's recovered from the last few feeble attempts to rest as it's moved up. So I hope that helps, and we'll see you in the next video.